This is how the Lehman crisis unfolded. Lehman Brothers was a name that awed the markets before the financial crisis of 2008. Yet it collapsed on September 15th, 2008. How did it collapse despite being the fourth largest investment bank in the United States then? The magnitude of the collapse made Lehman an enduring symbol of the excesses of the 2008 crisis. The bank was swallowed by the subprime meltdown that swept through the financial markets. It was so devastating that loss in economic output ran into trillions of American dollars. Mauled and then finally massacred by the crisis, Lehman Brothers couldn't avoid going under. Lehman finally filed for bankruptcy on September 15th, 2008. Like in many corporate collapses, unrelated non-core diversification sowed the seeds of the Lehman bankruptcy. Though started as a dry goods general store, Lehman Brothers spread into volatile commodities trading. It diversified also into brokerage services. Bitten by the bigness bug, Lehman finally converted itself into an investment bank. Bad luck, Lehman Brothers came under serious stress when the subprime mortgage market collapsed. Lehman began to bleed profusely, as it was into the mortgage-backed securities business. It was early 2000. Blinded by brash ambition, the firm quickly bought over 5 mortgage lenders. As losses turned huge, continuous and consecutive, the Lehman stock crashed. Fearing a run and finding a fast way out, Lehman Brothers filed for bankruptcy. The Lehman store was started by German brothers Henry Emanuel and Meyer Lehman in Alabama in 1844. The beginnings were good. As U.S. farmers settled purchases at the store with cotton, Lehman forayed into cotton and then into commodities trading and brokerage and finally into investment banking. The year was 1899, a golden moment for the brothers as they flourished, much like America. By the middle of the 20th century, Lehman was a financial giant. Lehman managed to grow despite numerous challenges. It managed to survive the railroad bust-ups of the 1800s and the cataclysmic Great Depression. It survived the 2 world wars and the Russian debt default. Yet Lehman could not survive the catastrophic collapse of the American housing market. Lehman's ultimate demise was caused by its reckless dive into the perilous subprime mortgage market. That was made worse by its entry into questionable mortgage-backed securities. The American housing bubble was developing fast by then. Lehman went on an overdrive to assure investors. Consumed by greed, Lehman went on to acquire, between 2003 and 2004, 5 mortgage lenders. These 5 were deep into Alt-A loans. Alt-A loans are loans given to borrowers without full and satisfactory documentation. As revenues rose, Lehman began to believe in its ability to see things beforehand. Lehman was just becoming overconfident. Risky diversification and reckless overconfidence were becoming a toxic mixture. Yet Lehman was blissfully unaware and unbothered. More so because Lehman was posting record profits year after year from 2005 and right through 2007. As Lehman's stock rallied, it was turning euphoric. This was despite the cracks that have begun to appear in the American housing market. Defaults began to happen, and by end 2007, they were breaking records. Then began the fall of the Lehman stock. Lehman went on an overdrive to assure investors that all risks have been taken care of. Yet Lehman could do nothing about the credit crisis. In August 2007, 2 Bear Stearns hedge funds went under. As decay was setting in, Lehman began layoffs and shutdowns. Worse, it began to stop its Alt-A lending. Still, Lehman remained a major force in the mortgage market in 2007. Its mortgage-backed securities portfolio stood 4 times its shareholders' equity. That was Lehman's last chance to prune its mortgage portfolio, but it missed the bus. Lehman's leverage was at an all-time high of 31. It became highly vulnerable to market shocks. Inevitably, the Lehman stock lost nearly 50% over rising fears of its failure. After Bear Stearns collapsed in March 2008, fears of Lehman collapsing began to gain ground. Worries over the quality of Lehman's mortgage portfolio were intensifying. Losses were mounting quarter after quarter. Lehman began selling its divisions and spinning off its real estate assets. Yet its stock continued to dive. The career development banks put on hold its decision to take a stake in Lehman. This hastened Lehman's collapse. Worse, hedge fund clients and short-term creditors began deserting Lehman. Lehman's finances were in a tizzy now. The only way out for Lehman was to go for corporate restructuring and sell a big stake to a strategic partner. But that remained a pipe dream as the Lehman stock was still sliding south. Clearly, time was running out. Even takeover attempts by Barclays and Bank of America did not work out. Inescapably, Lehman had to declare bankruptcy. So, the Lehman disaster was caused by a combination of many factors. Bursting housing bubble, subprime mortgage lending and high-risk loans to lowly rated borrowers were responsible. Also, repackaging of high-risk loans to sell them to high returns hungry investors played its destructive role. This was made worse by shaky lending standards and lax regulations. Lehman has always been described as too big to fail. At its high, Lehman's market value was around $46 billion. How this vanished in a jiffy continued to roil investors. To this date, one question is being asked again and again: why Lehman was allowed to go under? Why Bear Stearns was helped to be acquired by JP Morgan Chase, but not Lehman? Bank of America could have saved Lehman, but after the government's refusal to help, Bankum had second thoughts. Bankum too backed away only to buy Merrill Lynch. The tragedy is that the too big to fail Lehman had already become too bad to buy. The Lehman crisis is a constant reminder of how nothing is forever in the world of finance and investments.